So welcome to the Investment Cuddle, episode 8. I'm Gary and I'm here with
Philip.
And today on the podcast we're going to talk about credit rating agencies. So Philip, what's your view on credit rating agencies?
Well, effectively, what a credit rating agency does is it looks at the financial positions of companies, their balance sheet, their cash flow, their business model, and forecasts what it's going to be like in the future to give a probabilistic opinion on how well they can support the debt. They can finance the debt, repay the coupon and the original principal back. So it gives you an idea of how risky they are to other investors who want to buy their debt and invest that way.
Right. So they're assessing risk. How do they do that?
So they will go through the financial accounts of the company. They will look at the business model. So how do the company generate money? How much debt they already have? How much they can grow from their current portfolio of products, and to some degree extrapolate into the future to see can they support their current level of debt or the extra debt they might be taking on. What's the risk that they continue to pay the coupons for the bonds and actually refinance the debt at the end of it and pay the principal back? Right. So it's all based on there. So try and ascertain a risk level so that the other people who are going to lend them the money, buy the bonds, can assess how much they prepare, what demand is interest payments to cover for that said risk.
Okay, so that's a credit rating agency. Now, to me, a credit rating is something that's specific to me, and I guess that would be someone's assessing my risk level. You're not talking about the credit rating agency that would tell me what my credit rating is, are you?
You're thinking of the credit agencies Equifax and Expedian. They look at you as a person and say how much debt, collect information on you, which will then allow banks or other financial institutions to say, is he creditworthy? How creditworthy is he? And therefore how much I'm going to charge in interest, because I'm fearful about whether you can pay it back or not. So very, very similar to what a corporate credit agency would do is what they do. The only difference is it's a completely different companies that do it. The ones who tend to do to people, like I said, were Experian and Expedia for corporate credit, and international credit, should we say, for governments and companies. It's 3 different companies who make up 95% of that market, and they're known as Moody's, Standard & Poor, or S&P, and Fitch. They're the 3 big credit rating agencies for corporate and government debt.
Okay, so they'll do a similar thing in the corporate world that they would for me or for an organisation that I'd applied to get a credit card from, for example. They'll do a similar check on me. But it's personal versus corporate.
Yeah, and they probably go into more detail because there's far more money involved and people lose far more money if they get this wrong.
Yeah, I'm just thinking from a credit point of view, people say about how do you get your credit score up, and whilst we're not looking at necessarily covering individual credit scores today, there's always been you go and try and get a mortgage or a loan. If you don't have any credit history, you're going to really struggle to get a loan. So that goes back to the credit card point, where if you just have a credit card, you don't always have to use it very often, but just get a credit card, and that will at least it will register a score.
Give you a history.
Yeah, it will register you a score, won't it? You've got some runs on the board that says I've got some history, and it's easier for them to register a risk number or however they do it against you when they know you a little bit.
Yes. For the corporate credit rating agencies, these aren't small companies that go to a bank and ask for money, because the bank makes its own decision on what it thinks the company's worth. This is where you're going to the open market. So this is if you're going to put a bond on the open market, not via a bank. You're going to do a mortgage-backed security, a collateralized debt obligation, various other in corporate or governmental bonds that you're going to sell to anyone, not just banks. So this is the big end of the market. So countries have a credit rating, companies have a credit rating, but these are ones where you're lending money to the open market, not to a bank, because the bank will do its own and it may or may not be the same. Whereas if you're doing it to the open market, you've got many, many different people who'll be buying that credit, and they will want to, and not all of them will have the same access to the financial position and the financial information of the company who's issuing the bond.
Okay, so when I'm not going to use the B word, but during the process where the UK was looking to leave Europe, you know what that one's called, there was an article about the UK's credit rating changing during that period. So these are the kind of agencies you're talking
Yes,
about,
these
right?
are ones. I can't remember whether it was Moody's or Standard and Poor, but one of them during that period of time, we will put on watch, is what they said at the time. It's not that your credit rating dropped. It said is it could change. This is a warning, and mainly it's because you have a change in future prospects. At the time, they couldn't decide whether it is a positive or negative change in future prospects. All they noticed was it will be a change.
Mm-hmm.
So therefore, this might change your rating, good or bad, because it could increase your credit rating, or it could drop it.
Yeah.
But they hadn't made an opinion because it's based on your cash flow position, your balance sheets, how you're growing. In the government's case, how are you balancing the books, your payments to income?
Okay, so that's the sort of thing that I'm aware of, I guess, in terms of country changes. You're also talking about companies
Yes.
as well. So pick a company, whether it's BP, Shell, General Electric. They're all issuing bonds to raise money.
Yes.
So those bonds will include a rating,
Yes.
essentially. How do they score those? How do you know what's a good or bad score for those bonds that are offered?
The basic rating system all three of the rating agencies use is based on letters. You've heard the phrase AAA.
Yeah, aware of that.
So what you'll have variations on AAA, AA, single A, triple B, double B, single B, triple C, double C, single C, D.
Sounds like a list of batteries, doesn't it?
Yes, it does. Very boring, but that's what it is. Where you have AAA being the best, D being the most risky. And when they're saying risky here, risk of default, so therefore the risk of you not getting, either they're going to default on the interest payments or default and not pay your bond back at the end. Now what they do is effectively they break all of those ranges into two grades. Investment grade and speculative grade, which is also euphemistically known as junk bonds.
Right. So
The reason why it was historically called junk bonds were pension funds, large insurance companies have a very strict limit on the amount of non-investment grade credit or bonds they're allowed to hold. So generally, if you went from being investment grade to non-investment grade, they usually had a very short window of which to get rid of the bonds, junk the bonds, get them off the books.
You don't want to be in high risk investments in a pension fund that you're going to have to pay people for X number of years. That's
right. So they've got a legal requirement. They can have a small amount, but once it's exceeded, they've got to bring it down, and so therefore they liquidate the bonds really quickly, get them off the books. And so the euphemism was called junking them. So they're called junk bonds, meaning a pension fund can't touch this. So, but generally that's a positive side because that means you've got to pay higher interest rates because you're speculative grade now. So Standard and Poor, they also have they use a plus or minus to modify to say, so basically a double A plus is better than the double A, but not as good as a triple A. So it gives them more categories in between.
Mm-hmm.
So AAA being the best, the lowest investment grade for Standard and Poor is triple B minus. For Moody's, they use 1, 2 and 3 modifiers, but effectively, as you can guess, their lowest investment grade is triple B 3, because that's the lowest in that band. Finch uses a plus or minus modifier like Standard and Poor, so therefore their lowest investment grade is triple B minus. A double B plus for Standard and Poor or Finch is the highest grade of speculative bonds, and the lowest being D, and you've got lots of grades in between. And every time you drop a grade, it's how the perception of your risk of you not being able to finance your debt.
Okay. So if you turn around and said, I want to take some risk in what I'm investing in, so I go for those lower grade or lower scored bonds, am I not recompensed for that with a higher yield, so a higher percentage return on those bonds than I would be if I'm going AAA?
To some degree, yes. So you'll pay, the company issuing AA or AAA bonds will pay a much, much, much lower interest rate than a company that's offering triple B minus bonds, but they will still be paying less interest than somebody who's got a triple C, and somebody who's got a rating of, say, a D bond is paying a huge interest rate. Whether it's enough to offset your default risk is the $64,000 question, because they always subtly change as they go up and down. You're in a band, but in generally, a AAA will pay a lot less interest than a triple C.
Okay. So if you take a practical example then, Philip, we've got, a bond fund. It's investing in, triple Bs all the way down to B and triple Cs. So they might end up with good returns.
Mm-hmm.
What you're saying? Why bother to invest in the higher rated stuff? Because these things never go wrong. Bonds are always secure, right? You don't have any issues with them. You just get bigger returns, going more risk. It's not like equities. Just stick your money in a high risk bond fund and off you go.
This is not true. Because the same company can have two different bonds that have two different ratings. You can have a AAA rated bond because there's assets as collateral for them. So we'll say Joe Bloggs Inc., just to make up a name, they put their factory's land as collateral for one of their bonds. That will be rated higher. We'll just say AAA for the moment. However, unsecured bond might be rated double B, below investment grade. Because if you go bust, you're at the bottom of the queue, just above shareholders, if there's anything left. Mm-hmm. Whereas the other guys, you default on that, they repossess the land. So something that's happened just at the moment is McLaren Cars in the UK. They are having to put up their historic Formula One car collection as collateral because people want collateral. So generally when you're looking at the higher rating bonds, it's because there's collateral behind them, not just the name of the company. Mm-hmm. When you get down to the lower end of the bond rating, it's probably because they're uncollateralized.
Right, so it's like taking out a mortgage and you're borrowing against the house versus a personal loan where you're taking it against...
And as you can see as a person, you can have a mortgage where you pay a low amount, yet your personal loan you pay a lot, yet you're the same person with the same income.
And the same credit rating.
Yes, because here the bond has a different credit rating, not necessarily the company. But yeah, right.
So the person that we are borrowing from, it's whether they see they need security or not, and therefore we will pay for the privilege by a higher rate where we're not securing anything.
That's right.
Against our home or something like that. So it does. What you're saying, it does matter.
Yes, and there is a natural default rate over the business cycle. There is always companies that go bust, and therefore the default on their credit. It's a very low rate, and then when you get to the recessions, you get higher rate. But every year there are still companies that go bust and default naturally.
Okay, but I guess my point would be, if you turn around and said, let's say the stock market goes down. In the unlikely event that the stock market ever crashes, let's say the equities are much more likely to go down. The value of that company is going to go down a lot quicker than the bond that you would be investing in against that company. So therefore, you're less likely to have a hit on your capital investment during a stock market crash. Is the bond safer or more stable? There's probably two questions there.
Somewhat depends, because this is out in the open market. Depends when you buy the bond. So when the company Joe Bloggs Inc. issues their bond, they will say for £1,000 they will pay a coupon of maybe £50 a year, so a 5% coupon, 5% yield. Now, say a couple of years later on, the market doesn't think the bond is worth its face value, its par value, £1,000. They reckon it's say £500. The company is still paying its £50 a year coupon interest, so therefore it's instead of 50 over 1,000, it's now 50 over 500. So your interest rate has gone up a lot. So it depends on when you buy, depends on when you're going to lose capital. But if you hold the bond to redemption and they don't go bust, you get your £1,000 back, which might be a lot more than the capital paid to buy it. Or it could be a lot less, because also there are some companies where the bond started off at 1,000 and they've gone to 1,500. Effectively, the guys who bought it for more than 1,000 are not going to get £1,000 back in their principal. So it gets very messy when you're doing it on your own personally. This is why often pays to have a manager look and manage it for you.
So coming back to the bond fund, because you're taking a much more distributed risk.
Yes.
Across those.
Often you can find bonds are not easily traded individually. Not all of them are at the smaller end of the market, so they're usually the big caps. So it can be difficult to do as a private investor, because you need to do quite a lot of investigations into their finance side. Are they safe to buy? Is what the interest rate that bond is offering worthwhile compared to the risks you're taking? It's not a simple calculation.
Okay, so again, I think for private investors, it sounds quite complicated to me if you want to go and invest in individual companies' bonds. So the better part of valor here is to look at individual bond funds if that's the route you want to go down. Potentially for a less turbulent existence than perhaps equities are, but we're not saying they're necessarily any safer.
Yes. I mean, and this is where, same with equities, you want to hold a portfolio of bonds, not just one bond, to minimise the default risk. Because there's a small default risk, but you want to spread it over more bonds you've bought.
Okay. So we've said the ratings do matter. So you talked about was it Moody's, S&P, Standard & Poor's. So these guys are setting the grade. So like you said, you've got that company that comes along, Joe Bloggs Inc., who wants to put some bonds in the open market. Is that rating that they get from the credit agency independent? Who pays for the rating?
The company issuing the bond pays for the rating. And this is where all the controversy comes. Because you could say the bond, there is a conflict of interest potentially from the credit rating agency and the issuer of the bond. Now, I'd fully recommend you go watch the film The Big Short for some of these, should we say, conflicts of interest, because they did occur during the Great Recession of 2008, 2009, partly through some of these with the mortgage-backed securities. And that film, they do a better job of explaining it in a far more educational and entertaining manner than I can today. But yeah, there is a concern about conflicts of interest. It's the guy issuing the bond who's paying for it to be issued. And are the credit rating agencies really giving you the right number? It's a guide, maybe not fact. You have to be careful.
Okay. So yeah, I guess it's a bit like you've reminded us about The Big Short, and for anybody that's not listened to episode 4, where we did our top 5 movies, I think that was number 5. It's a cracking movie, so do check that one out if you haven't already. But the thing that's on my mind with that is, let's take it to property. You go and buy a house, or try and get into the process of buying a house. You would have a survey done on that house, and the individual looking to buy that would pay for the survey traditionally, and there's been all sorts of chat about whether the person owning the house should have that survey done. But it's kind of that scenario where you turn around and say, if the person who owns the house gets the survey done and is paying the surveyor to survey their house, the bits that aren't good about that house have the potential for disappearing. And I'm not saying that surveyors wouldn't, that they are obliged to put all the information in, but it's that kind of thing where we're saying in the past there have been instances where bonds that were a lower rating in reality have been given a higher credit rating, which makes them easier to sell in the open market.
Correct. And if you want to see more of that, Big Short is a great place to explain it.
Check out The Big Short.
Yeah, but that happened a lot in 2008, 2009, or prior to that with mortgage-backed securities in the late 2000s. It's worthwhile maybe looking at some of the funds, because they employ a small army of people who go and look at the finances of the companies they're investing in. They use the credit agencies' ratings as guides, but not black and white. They put on their own analysis as well before they go and buy. And this is where you're looking at a tracker, for corporate bonds anyway. Personally, I find that a little worrying, because you're totally reliant on the credit ratings agency's numbers. And if it's weighted for the market of debt, you're just buying more of the most indebted company, who, how do you put it, psychologically, that doesn't quite sound right. You're buying the most indebted company, because it could just be that it's not just they're the biggest company, they've just borrowed lots of money, but they're actually quite a small company. So therefore I'm quite wary of trackers for corporate bonds, personally. Others are different, but for corporate bonds, I actually want someone to actually look at the numbers before they go and invest. So I personally pay for active management in that area.
So I think we're just picking up then on the balance between the tracker being a tracker in itself, where it just follows the market, and an actively managed fund where bonds are concerned. Potentially it would be good to look at active funds.
Personally,
actively managed funds,
yes.
Sorry.
Personally, that's what I do, yes.
Yeah, and I agree with that. I think because bonds can be a bit scary if you've not dealt with them before. And in a standard portfolio, people talk about this, 60% versus 40% bonds versus equities. So you should have a relatively stable 60% in bonds, and then you've got hopefully some growth and some dividends on the equity side. But the difficulty there is, what we're just saying is, be careful what you wish for, because you've got to either be very careful and do the research and look at those ratings and understand that you need to read between the lines of the score and just not take it at face value for the trackers. And for an actively managed fund, you can actually look at the previous history, you can start to have a delve into what they're actually investing in, and that they are doing that research for you.
And just to be really clear, when I'm talking about the trackers, I'm talking about corporate bonds and, should we say, emerging market or non-developed government debt. When you come to developed government debt, particularly the very big ones or the country that you live in, here in the UK, a tracker fund that follows UK government debt, which is called gilts, I would be more happy to have a tracker do those because they're in 3 to 5 year or 5 to 10 year. That's the market, you can follow it. The default rate of the government is probably similar across most bands, but it's when you're moving to emerging market government debt or corporate bonds, I personally am uncomfortable with trackers that just follow momentum. I want to have a person because there's big events there. Because the tracker said that Argentina was great, yet it's only a couple of months ago Argentina defaulted for something like the 15th time in its history, over 200 years. That's a certainty now, not the default rate with Argentina, not an if.
That seems like quite often, doesn't it? But you're right, I think, so when we talk about the trackers, we're talking about, exchange traded funds, that kind of format, aren't we?
They're predominantly the trackers, but you can get tracker unit trusts.
So, Philip, you've mentioned Argentina there.
No, can we keep it?
Producer Keith, I'm going to leave a little snippet in next time. So, Philip, you mentioned about Argentina, and they're defaulting a number of times. Haven't they issued a 100-year bond recently?
Yes.
What does that actually mean?
Well, that means the redemption, where they repay the principal or the capital back, is in 100 years' time. Because you have a duration of a bond, so you can have ones that could be a couple of months, a couple of days, overnight, years, decades, up to 100. Well, you can actually have perpetual bonds where there's no redemption date, no fixed redemption date.
Right. So who would be buying? So this thing. So I'm definitely not going to be here in 100 years. That's almost a certainty, unless there's some improvement in genetics or cryogenics, maybe. But who's buying that?
That's a very good question, and maybe something we should say for another day, because I do know who did buy a lot of those. And let's just say when Argentina recently defaulted, his fund made colossal losses of tens of billions of pounds or tens of billions of dollars.
Okay, but is it a hedge fund?
No, this is a bond fund. This is like a $2 trillion bond fund,
right,
PIMCO.
Okay. Oh, right.
Or Franklin.
Okay.
These are some big, and he's a very star manager who bet.
And lost.
And this time, it was in emerging markets, who are known to be volatile because their government can just say, that bond I issued, I'm not paying. Quite regularly they do that, because they're offering very good interest rates because of that risk.
Yeah.
So there's a lot of questions about shouldn't you buy things of that nature. That's maybe a story for another podcast, because that could go into a lot of detail.
Okay, so but from what you said earlier on about the ratings, let's say UK pension funds are not going to be able to buy that 100-year bond. Is that correct?
So for like in the UK and in the US and most developed nations, investment companies such as who run pension funds or life insurance companies, they can hold a certain amount of non-investment grade credit, whether that's corporate or governmental.
Mm-hmm.
So once they've reached that limit, they have to get rid of any excess. So if a country or a company gets downgraded from investment to non-investment grade, they may have to get rid of it because it might go above their threshold. And their thresholds, I don't know exactly what their thresholds are, but they're not very big. They might be 5% of total portfolio.
Right.
So it's a big thing if you knocked out of investment grade.
Okay. So UK pension funds are not going to be buying a lot of that type of
There
debt.
would probably be a lot of sellers of that if you went from being high to low.
Okay. All right. Well, thanks, Philip. We've covered quite a lot there. I think just trying to understand what the ratings mean against what you could potentially buy. Mm-hmm. So thanks to Philip, and we'll see you next time.
This programme has been presented for information and educational purposes only. None of the information or content of the programme is to be taken as an offer, opinion or recommendation by the programme's hosts or guests to buy or sell securities. Nor is it intended to provide legal, tax, accounting, commercial or financial advice. Opinions and comments are based on information from sources believed to be reliable. All investing involves risk as prices go up or down based on a number of factors. Always consider consulting a financial professional before investing.